Welcome to Business Discovered. This is your host, Ernesto Del Bosque. Today we're covering over the collapse of Silicon Valley Bank. If you've been watching the financial news, this is all over it because they're comparing this to 2008 and taking this bank failure as in it's just to start. So today I'm be talking about what happens when a bank fails and if this massive bank run is going to be the first of many that's coming up here. So I'm not going to be like the news and say it's all doom and gloom, but I'm not going to say it's all sunshine and rainbows either. We're just going to look into the facts of what actually happens when a bank collapses. First, I want to cover what is a bank run and how big this threat is to the banking industry. So first, basically, a bank run is when everyone tries to rush and withdraw the money all at one time. And this is usually an issue for banks because they don't have everyone's deposits on hand. So if you think about what a bank is in the business of doing is lending out money and getting a return on those funds. So usually a bank will have some portion of their deposits that were given to them and lending out loans, maybe some investments in there. So they don't have everyone's cash ready to go all at one time. So it's very possible that bank runs could potentially happen and shut a bank down because they won't simply have enough money to give people back their money if they all demand it at once. So this is a very real threat and it's happened many times before. Back in the Great Depression, back in 2008, the most recent example of it happening on a massive level. So it's not impossible. It's a very real threat. It can happen to any bank, and no matter how good and health of the bank is, just because they don't have everyone's cash on hand. So to prevent this from happening, people going into the bank all at one time is banks are required to have a certain percentage of funds on hand for depositors at any given time. And this amount is usually set to something reasonable to where people are not actually reasonably going to come and just withdraw that amount of money out of the bank. So the likelihood of this happening is not very high at all. Second thing is to ensure confidence in the banking system. So people need to believe that if they put their money in the bank, they're going to be able to get it back out. And if the bank does fail, not to panic, not to pull the money out, therefore not making that self-fulfilling prophecy. So if I believe a bank is going to fail, I'll pull my money out, which means the banks to pay up more money. And if people do that, you're going to make it happen, even though it probably wasn't going to happen. This is what FDIC is for, is Federal Deposit Insurance Corporation. They will insure up to $250,000 per depositor. So if I have $200,000 I put into that bank, they will guarantee that funds that, hey, if that bank fails, you'll be able to withdraw it out. This is supposed to instill confidence in the banking system, knowing that, hey, my money is safe. If the bank does fail, I'm still going to get my money back, to ensure people will be protected if a bank does fail in that unlikely event. I used to work in banking for many years, and I've seen this happen firsthand to where a bank did fail. FDIC stepped in on a end of day Friday. That bank shut down. FDIC came in and said, you know what? Your bank is collapsing. You could no longer function. We're going to step in and we're going to take over the bank and be the administration of it. We'll run the day-to-day processes. And eventually, after we make your bank in a better health, we're going to sell it off to another bank. And that's exactly what happened. On Fridays, FDIC stepped in, took over the operations of the bank. And by Monday morning, literally over the weekend, another bank had bought them out. As a customer, the only real change you had was to change the name on the bank. They had access to the money by Monday. They had maybe minor disruptions over the weekend, but that was it. That's all what happened. It wasn't all doom and gloom. There was no panic. It just simply change of hands. So let's compare this into what's happening on Silicon Valley Bank right now. Everybody started withdrawing their funds at a very high rate in a short span of time. Over the past few quarters, they had a very large amounts of people withdrawing their banks. And when people found this out, they started to panic. They started telling their friends to pull their money out. And they started pulling money out. And other companies started pulling money out. And due to this, on Wednesday, March 8th, the bank announced to their shareholders that, hey, we need to raise some money quickly, not to panic. Everything will be all right, but we need to issue more shares. So that way it could raise money to we could meet the demand of our depositors. And when people heard news of this, they panicked even more. I know they can't meet the demand of their customers to want to give them their money back. So let me get my money first, so that way I make sure I get my money, even though it's insured by FDIC. Everyone started freaking out, pull their money out. Pulled so much money, they pulled $42 billion out in a single day. By Friday morning, March 10th, FDIC and the government of California stepped in and shut them down and took over the bank. So the bank closed Friday, and FDIC quickly said, hey, by Monday morning, people will start having access to their money again. If were FDIC insured, you get your money back. Sure enough, Monday morning, which is today as if I'm recording this, people were able to get their money. The FDIC would continue to control the bank until someone else could come out and buy up those assets of that bank, to buy out that location and take it over from the FDIC, which has already happened. 2 banks have already came in and bought some of their locations. HSBC Bank and one other one from the UK has already bought some of their locations. So this is already happening. So these banks are already changing hands, and it's not the end of the world. That's the whole function of FDIC, is to, if this does happen, to make this transition as smooth as possible and protect the integrity of the banking system, and so that way people are not affected by this change in any major way like that has been in the past. And so in conclusion, bank runs are a very real and big threat, but thanks to FDIC and their swift action, it's nowhere as a big threat it was in the past. And now these other banks are going to say, see this happening, and they're going to take action to prevent this from happening to them. So this big talk of contagion is not really going to happen unless something major, like really major, happens. And people are already getting their money back already. And even those who weren't insured by FDIC are still getting their money back. This is not something to be worried about at this time, but that's kind of how it breaks down. It's very simple. That is all for today, so I'll see y'all next time.